Hey guys, Dana Cornell from Cornell Capital. Hey, just had some thoughts. I was reviewing last week's markets financially. Many of you probably saw the bond markets, fixed income really took a hit, especially on Friday. So I wanted to go through some bond math, so to speak, with you guys. And keep in mind, most of you know this, but most people look at bonds or fixed income as their safe or secure investments. So really when I talk about bond math, what I mean is there's three components that make up potential return in a bond. So one is your manager's skill. So some bond mutual funds have an active manager that picks and chooses those bonds and positions them in the right ways and makes those calls. If one manager is much more skilled than the other, that's a huge advantage. Some funds don't even have a manager. It's just a blind pool of investments. So that's factor number one. How good is your manager? Do you have one? Are they adding value? Number two is price movements in bonds. So as interest rates go up, price movements go down, meaning the price of your bond or the value of what it's worth goes down as interest rates go up. So that's another factor that could adversely or proactively help your bond position. Now we've been in an environment of lowering interest rates the last 30 years. This year it looks like rates are going to start to go up, which negatively impacts your fixed income holdings. Again, what people think are your safe investments. And third is the income that it pays. With interest rates being so low for so long at this point, they're really not paying very much. Most bonds are paying 2% or less. So that also doesn't leave very much cushion when we're looking ahead, looking at interest rates that are going to start to continually rise. We can argue how much and how fast that's going to happen. Every investment firm or economist has a different opinion. The reality is everyone agrees that rates have to rise at this point with the amount of inflation that we have, which I mentioned on one of these previous videos. So I say that to really warn people. I think that's a risk in the market and investments in general. It's almost a false sense of security. Bonds have been sold to people, to investors, as your safe and secure investment. The reality is they just have different risks of their own. And we're in a perfect environment for the math of those three variables I just walked you through to add up to a negative impact on what people think are their safest investments. The good news is there's other ways to generate income. There's other ways to protect your money through alternative type investment strategies, stuff that we focus on in my firm on a daily basis. If you'd like to learn more, if I can help you personally, shoot me a DM, comment on this, and I'll keep you guys updated as things come to mind. Thanks.